Hello, and thank you for joining us today for another virtual session on global leadership. I'm Rachel Pavanko, Director of Global Experiences at Worldstrides, and today I'm sitting down with Brian Dunhill, International Financial Advisor at Dunhill Financial, joining us from Barbados today. Brian, thank you so much for joining us and sharing your thoughts with us.
Thanks for having me, Rachel.
Yeah, do you want to start by telling our audience a little bit about yourself and your background?
I'd be happy to. My name is Brian Dunhill, as Rachel said, and my company, Dunhill Financial, has been around for a decade, helping American expats travel anywhere around the world and deal with their finances, from basic financial planning to investing, all the way down to their estate planning needs. We have clients in every single continent except for South America and Antarctica at this point in time, one for the lack of people and one for the lack of Americans and experience down there. But the majority of our business comes in Europe, as we started the company in Brussels, Belgium, and with some of the complexities and changes that came along with Brexit, we moved the company over to London, offered an opportunity for us to grow and blossom as the city went through some changes, and that's where we've been for the last couple of years.
Awesome. So diving right into questions. So could you talk about a little bit about how Dunhill Financial stands out from other financial advisor institutions?
Most definitely. We're being an American expat player. There's only a few American expat firms across the globe. There's several that claim that they handle these types of situations, but there's only about a handful in London that are duly licensed in the United States with the SEC and in England with the FCA. This means that we're really able to deal with cross-border issues. We're able to sell accounts like IRAs and 401ks back in the States and ISAs and SIPs in the UK. So we're really able to take care of all of the issues. When you consider that there's 170,000 to 200,000 Americans in the UK alone, 9 million American expats globally, and those numbers are only increasing. The fact that there's only a handful of carriers that are legitimately licensed to do so leaves us in a niche, or as the term goes nowadays, in a blue ocean strategy to deal with that marketplace.
Gotcha. And how do you think your background specifically enables you to look out for the financial interests of American expats?
Well, simply said, whenever I meet a new client or a new prospect, the conversation is typically, this is how I conduct my own finances, and therefore I'm only replicating it for you. I've spent over half of my life in Europe and the United Kingdom. So I was born in Belgium, I grew up there, moved to the States, so I understand how both sides work. We also have a business that deals with non-Americans. So we're not just saying we can only deal with the American side of things. We understand how both sides work.
Understood. Awesome. So in terms of investments, and because you're working in so many markets, what sort of trends are you seeing, and do they vary drastically based on the region that you're looking at?
Most definitely, they vary in a big way, because every portfolio that we're designing for our clients have the end in mind, i.e. where they're going to use the funds. In technical terms, we call this natural hedging, but in non-technical terms, it's more just plagiarism. We build a portfolio for a client that's going to end up in Europe that looks like what a portfolio manager would design in Europe, but we're using instruments in the United States so that they conform with the US taxes, but that we don't have the same level of currency risk of using, say, a Goldman Sachs or a Wells Fargo or a UBS model that their financial advisor back home would use. So it's not reinventing the wheel, it's just designing something that looks like the portfolio in Europe, but doing it in the United States.
Understood. It sounds like a lot of moving parts. Certainly not something I'd be able to keep up with too well. So I do want you to talk a little bit about advising American expats. Could you talk about some of the differences you see in advising them versus others, and maybe what sort of barriers and challenges exist for them that may not exist in other markets?
Well, I'd say that the most complex issue is that there's always moving parts. And in only a decade of running this company, we've had huge changes in America with the FATCA Accords that Obama put in place back in 2011. That essentially made it so that all of the United States forces and the IRS and the Treasury were able to look under the hood of all bank accounts in foreign jurisdictions. This meant that old rules that Nixon put in place, that Lincoln put in place, and that Reagan put in place were able to be enforced very easily. On the other side, we had new implements of rules like MiFID in Europe that essentially made it so that European jurisdictions started to all behave in one fell swoop. And all of a sudden, we had to try to marry the two sets. No regulator had thought about these American expats. So when we talked to the regulators, it wasn't a conversation of this is how we imagine this. They were just looking at us saying, well, how are you interpreting it? And you tell us how we should do it. Very different from being in a university in the United States where there's 600,000 financial advisors and the SEC makes the rules for all of them. We have to interpret the rules. We have to try to figure out whether we're being conservative or aggressive on those, and make sure that both sides are fine with them.
Absolutely. And what would you say your top challenge or factor is that might surprise expats if they were now trying to move out of the United States to the UK?
Well, there's a lot of them. So the main issue that we deal with constantly and that we're always talking to our clients about is currency exchange. And especially this summer, with all the changes in the markets, we've seen big currency movements. We've gone from a decade of the dollar going up to a 5% drop in a month. We've gone from a lifetime of the renminbi, the Chinese currency, devaluing themselves to the renminbi growing 4% over the last 4 or 5 months, to where I thought that it was going to be something for the next generation of my firm to deal with. The renminbi's rise, now we're talking about it on a weekly basis. So currency movements become something that expats have to really take into account. And then cross-border issues, double taxation agreements. We talk about them constantly. There's 60 to 70 pages of cumbersome material that are interpreted more for corporations, and then we're having to deal with them for individuals, which most of them haven't ever thought about. So for instance, in Australia, if you leave as an expat, you're going to be taxed on the way out on your super, which is your pension account. And then the Americans don't really think of it as a pension account, so they double tax it. And these are those cumbersome issues to where if you know it beforehand, you plan with that in mind, that when you're negotiating with a company, you're dealing with those issues. If you don't know it, all of a sudden you think you have a large pot of money and you walk away and both tax jurisdictions rate it.
Wow, that is, it sounds rather complicated. Perhaps I won't be moving anytime soon.
No, it's not moving. It's just all about being informed is what it comes down to.
Absolutely, absolutely. I want to pivot a little bit and talk about technology in the financial institution realm. Are there any opportunities that you're taking advantage of to improve services, maybe working with AI or other digital technologies?
Absolutely. It's there's two sides that are evolving in the financial services world, and those two sides are compliance and technology. Any of the firms that are not moving those as their forefront causes are basically slowly dying out. And the first of those two problems is the costs that are associated with them. Essentially, in the time that we've run our firm, we've seen nearly a doubling in cost of all of our compliance factors, and we've seen our technology costs grow by about 50 or 60% in that time period. Now, a lot of those are new tools and widgets that we need to utilize because the consumer wants more. They expect more. When I started in the business 20 years ago, essentially we were still on emails and sending out what the quote was on something because most people had a huge delay or they were on dial-up internet. Nowadays, everybody can access every single price. And now we're talking about data aggregators. All of our clients have access to all of their accounts, no matter whether they're held with us or externally, because they want to talk about all their financial planning, whether it's with us or outside of us. We're talking about bigger financial planning tools in those access points, all the way down to just simple little things like being able to book an appointment directly through us. But if we're not giving the clients the access points that they want, they're going to find it from somebody else, or those providers that are offering some of those other accounts are going to be pitching those types of services. We're also in the background on the analytics. We're having to dig deeper and deeper, and this is so important when it comes to social responsibility. Our firm is on a 5-year initiative to be a fully socially responsible firm, and it's not the question, and why it's a 5-year initiative is because it's not the question of, oh, do we want to be socially responsible? It's the definition of how do you define social responsibility. So for instance, at the beginning of COVID, we sold out all of our real estate positions. We didn't think real estate could survive this. We bought a bunch of e-commerce companies. Quite obvious now that we're 6 months into it, but at the time, it was a very quick change. And some of our clients were very upset because when we bought e-commerce very quickly, we bought Amazon in some of our portfolios. And some of our clients astutely said, Amazon is not very socially responsible, of which my definition of social responsibility is the environment. That's what I put first. But for them, it was labor relations. And now we're able to sort companies based on those different factors, not just does it meet SRI, it's does it meet the factors of being good for the environment and labor and a bunch of other functions. So being able to sort all those data sets is so important in analyzing companies and getting a portfolio that the client really wants.
Awesome. And actually, you touched on what will be my next question, so I'd perhaps ask you to build off of that. But in what ways, high level, besides then this real estate shift, has the pandemic shifted your strategy as a whole?
Significantly. I used to be on the road probably 3 weeks out of the month, traveling through Europe, meeting with clients, sitting down with them, eating dinner, eating lunch. Now, most of the time I've been spending in London. Now I'm in Barbados, but still the same premise that I'm behind a computer having conversations like this. Some of our older clients, it took this pandemic for them to adapt to that. But we still wanted to have a social aspect. So we still host client events. We host wine tastings where we bring in a wine connoisseur to talk about some wines. We ship some wines to our clients so that we can have a social aspect, just like we did in the past having dinners. So it's evolving the businesses and such, and that's helped us grow in a significant way because by adapting to this change, now I'm not spending the time on the road. I'm actually spending the time with clients constantly. And that's giving us the opportunity to host constant webinars. So we're touching our clients more often. If you look at our YouTube channel, we've probably posted more this year than we have the last 9 years combined. And that gives us that competitive advantage that when times are bad and we're constantly communicating with our clients, whether it be news that they want or not, they at least know that we're there for them to answer their questions. If we don't communicate with them, if we wait and say, well, I'll let you know when I'm back on the road, all of a sudden that relationship can fall apart. And that's where most clients fire their financial advisors during those bad times, is because of the lack of the communication, not because of the lack of the markets performing.
Gotcha. Yeah. Wow. That's it's nice that you've been able to pivot in a way that benefits your clients as well and really gives them that peace of mind during all of this madness. Have you noticed a demand for any specific type of service that you offer during the pandemic? Like has what has been in demand shifted drastically for you?
Yeah, we've had surprisingly more people wanting to get in the market that have never been in the market. And a lot of that is just because of people having time. You know, when they're on furlough, when they're no longer working, all of a sudden they can concentrate their minds at, I've got X amount of money in cash that I've never been able to figure out how to invest. How do I do so? I've got these pieces in the States. And meanwhile, the dollar's going down, and who knows what the pound's going to do. Maybe I should be thinking about getting it over into the UK. So it's focused people's minds on getting into the overall markets. But people are talking about currencies. They're talking about other strategies that I've never heard somebody, in the past call me with the first question being, how should I manage my currency risk? Most people thought the currencies were pretty stagnant before this crisis.
Oh, wow. It's a lot of change. So this will be probably my last question then on the pandemic, but What do you think the lasting impacts of COVID-19 will be on consumer spending, and what new trends do you think could develop as a result of the pandemic?
Well, naturally, any technological trends are going to continue coming out of this crisis, and we shouldn't really take that out of this crisis. We can look back to the 9 epidemics and pandemics that have happened in the last 20 years. You know, the most prominent one was SARS back in 2003. The Chinese effects of e-commerce continue to perpetuate. So that's to where we always look at it as a breakdown of the overall market. What sectors did the best? Number 1 was healthcare back in 2003. Number 2 is technology. Number 3 were consumer staples. Makes complete sense. Now, after the epidemic of SARS ended, essentially healthcare stocks and consumer staples didn't do as well, but the technology stocks kept growing. So what did we do? We took that information, we ignored all these politicians that keep saying, oh, this is unprecedented. No, that's I don't want to take responsibility for these decisions that I'm making, and I don't want to look into the past. These are all precedented. We can look at all of these past pandemics, epidemics, going all the way back to the Spanish flu or the plague. They have all happened. Sadly, the same things happen. Those are the same 3 sectors. They always perform those same ways. Hence why the markets are heavy in technology. We're ignoring healthcare and consumer staples at this point because of those past precedents. But the other precedent is that typically what happens is we have a K recovery. And a lot of reporters, a lot of economists have been talking about whether we go into a V, a U, a swoosh, or any of those types of shapes, which is basically you go down and you go up. Historically, that never happens. We typically have a K recovery. Now, a K recovery being that we go straight down, and then essentially the rich get richer, the poor get poorer. That's making a K. Sad that that's typically what happens, but it makes sense when you think of these reports that 60% of restaurants are going to go bankrupt in the next year. Whether that number be accurate or be true, we know a lot of them are going to fail. A lot of small grocery stores are going to fail. But if you're a chain like Darden or McDonald's or Pizza Hut, Domino's, they can access capital, and the government has lowered interest rates, so it's cheaper for them to access that capital, and they're willing to buy most of that debt onto the Federal Reserve's books. Same thing's happening with the European Central Bank, same thing's happening with the Bank of England. So these companies are able to access credit for dirt cheap. Meanwhile, their competitors, let's just call them good food, essentially are going bankrupt left and right, meaning that they're able to capitalize on that bigger structure. So it's not what we're rooting for, that the rich get richer and the poor get poorer. It's just naturally what happens in these types of reactions, and when the government reacts in those ways. So we shouldn't be surprised that our stock market can continue to grow even in odd sectors like restaurants, because they can think out longer term and their competitors are going bankrupt.
Wow, that is excellent information, and I had not heard of a K-shaped recovery before, so that's really, really fascinating. Something I'll definitely have to look more into. So I want to shift gears for a quick minute and talk a little bit about Brexit and what that was and is looking like. So we know, of course, that the UK was on track to exit the EU this year. In your opinion now, with a pandemic going on and a lot of other external factors, how do you think this deal is going to move forward, and what do you think the effects are going to be?
Well, trying to predict Johnson and his group is kind of putting yourself in the way of a car crash right there. I'll point out some of the obvious factors, which is that we have to brace ourselves for some sort of a hard crash economically. Now, naturally, we'd only expect the government to say that most of that is coming from COVID, but the only precedent that I've been able to associate with it was when the United States actually was at the time the United Colonies, and they left the Commonwealth to become their own nation. When they founded for independence, the U.S. economy shrunk by 46%, and it took them 15 years to get back to the same size that they were when they were the United Colonies. Not a perfect analogy to leaving the European Union, because naturally we're in a service-led economy, et cetera, et cetera. So please don't send your hate mail if you disagree with me on that. I think it's just more fair comparison that when you no longer have free trade, we can only expect nationalization to take a big toll on the current economy, because it takes a long time, a decade plus, to get back to where we were. That's the only thing that I can really expect with Brexit. We have to hope that some of what's going on right now with the Johnson administration, with their views on rescinding their own deals, is just posturing, and that we come to some sort of terms. But regardless, it's a bigger aspect that they need to come up with big trade deals quick, and we can only expect a good decade or so of slowness before we can even think about a recovery. But the last time that we saw the UK going through deflation was the 1960s, right? At the same time, we were looking at a demographic shift of people moving outward out of the UK, right? Which essentially, with Europeans not being able to be eligible or be able to flood into the UK, we can only expect a demographic shift out. Plus, on top of that, we're 10 years demographically behind Japan. So all we have to do is follow what happened there. There, they've gone from 50 million citizens to 110 million, from 1950 million citizens. 1990, they got up to 110 million. We're down to what, 80 million people in Japan. We expect to get back down to 50 million in 2050. That's not because strange things are happening in Japan. They're just 10 years older than Europe and the United States. So we will follow those same trends, and we will go back on that same demographic shift. That follows suit with what happened in the 1960s, what happened when we have a demographic shift downwards and deflation in the UK in the 60s, 2 IMF bailouts, and then essentially a desperation to move into Europe. 2 votes, Charles de Gaulle kept them from joining, and then all of a sudden they were allowed in, and they were allowed to flourish because of the rising population. So the prospects of the United Kingdom, when those are the trends, bleak. Look at 5-year trends of most stock markets. Nearly every stock market around the world has done well over the last 5 years. The FTSE 100, not so well, it's negative. You look at the pound, nearly a 50% drop over the last 5 years. There's nothing attractive in the United Kingdom because there's no leadership, there's no semblance that we can build upon, that industry wants to build upon. So essentially we have to put our hands up and see what comes out of it, and wait for the knife to hit the ground before we try to pick it up.
Yeah, wow, that is very complex situation that you guys have over there. So I do have one final question, I think, before we close here. Have you seen any novel challenges or barriers develop outside of COVID in light of recent political circumstances, both with the US and the UK?
There's plenty of them. Like I was talking about with MiFID, this has brought about a ton of challenges because of the interpretations that go through with those types of things. And that makes it harder to do business cross-border. More and more companies are sketchy of interpreting somebody else's rules of how it should work in the United States or should work in Europe. And then the UK is having to interpret all these laws that are coming over from European laws that might shift or might just get ignored. So it becomes an interpretation of an interpretation. And then the commercial side of things is having to actually make those determinations instead of the dignitaries saying, this is how we envisioned it. So those complexities are only going to grow with Brexit, with the separation of the European Union from the United Kingdom, because that's not how it was meant to be written. Then you add on to that the new double taxation agreements, where people, for example, when you look at Starbucks, they run most of their branding and such through the Netherlands, but they run a lot of the other business through Ireland to minimize their taxes. When you start putting these things into effect with double taxation agreements that are having to be rewritten and changed, most corporates, most individuals are going to be in a complex time because it's not written in there for us. Gotcha.
Wow. Yeah, that sounds like a lot of moving parts and a lot of things that will be changing in the very near future for all of us. Well, Brian, I don't have any other questions, but do you have any other closing thoughts?
I think it's a complex world, but it's a fun world to evaluate. I don't think anybody should be ever scared from moving abroad or from working abroad or working in global situations because of these complexities. These are the things that make it interesting. So I would definitely say jump in, join the 9 million of us that are abroad, get a great experience abroad, and enjoy yourself with it.
Awesome. Well,
Thank you
Brian,
so much for the time.
yeah, thank you so much for spending some time with us today and sharing your thoughts. We wish you and Dunhill Financial the best of luck, and we look forward to connecting you with students in person in the future once travel comes back.
Wonderful. Thanks so
Thank
much,
you.
Rachel.